Hey, good morning. This is Jim Harvey, president of Opus Group, and this is your Money Week. In this session, I want to explore the concern and fear everybody has about are we experiencing an extended bear market. One of my favorite sites is despair.com. This one I particularly like. Is it too risky to invest right now? And this is a picture of a shipwreck. I think it's on the Oregon coast. Where it says risk. Anyone can steer the ship when the seas are calm, but wrecking a ship when the seas are calm, for that you need a dumbass, which I think is great. All right, let's explore this issue about, is it too risky to invest right now? The best slide I've ever seen about this is from our friends at First Trust, where they show the cumulative effect of investing $10,000 in 1970 in the S&P, and you end up with 1.7 million at the end of this period of time. And all the way along here, you've got all the reasons why you shouldn't invest right now, because, oh my gosh, there's, the space shuttle explodes, and Nelson Mandela is president of South Africa, and here's the U.S. invading Kuwait, and they downgraded U.S. debt. There's always a reason not to invest. And yet, if you just bought it and kept it, you'd have a lot more money. So the point here is, when you are finding a reason not to invest or pulling your money out, you lose the chance of getting this kind of return. The average annual return of the S&P for that period was 10.3% per year. So now, here's another way of breaking this down in much more detail, and I think this is really instructive. So here are all the negative years, and this is from 1927 through 2021. Now, we're not done with 2022, so I'll be able to update this slide in just a couple of months. Now, during this negative period of time, there have been 25 years of negative returns, 14 years of 0 to 10%, which is this area right here, and then 11 years of 10% or more, okay? And it was negative 26% of the time, okay? And it's down more than 10% only 11% of the time. That's just these 6 years here. However, here's the positive side of the equation. There have been 71 years of positive return. Now, I had to add 2019, where it was up 31%, and then 2020, which was up 17%, and then 2021, which is up 26. And so, obviously the market was up quite a bit these 3 years alone in a row, 72%. 14 years, same number of years of 0 to 10% positive, but 57 years of 10% or more. Only 11 on the downside, 57 more than 10%. And it's positive 74% of the time. Now, the average negative return during all of these negative years was down 12. The average positive return was up 19. So we call it the rule of 55, 65, and 75. And what do we mean? The market has been up 55% of all trading days. These are rough numbers, by the way. 65% of all trading months and 75% of all trading years. Now, I recall someone very close to me had said that her father said, "Oh, don't put any more money in the market than you can afford to lose." Okay, why? Because it's like going to Vegas. Well, I'll take those odds all the time. If I know that all I have to do is put my money in, and more than half the days I'm going to make money, 65%, 2/3 of the time I'm going to make it every month, and 3/4 of the time in trading years, I'll take those odds all the time. I'll go to Vegas, except I'll be the house instead of being the gambler. Okay, here are the actual data going all the way back through 1937, and you can see the numbers are not quite precise, 55, 65, and 75, but they're pretty darn close. The 1 day, 53%, not 55. 1 month, 63%, not 65. 3 months is there. 1 year, 77, not 75. And then you can keep on going and see all the numbers. So the probability of making money is pretty darn good in the S&P. And so don't open a vein because the market's down. Now, the other thing to bear in mind is that 65, 55, 65, and 75%, is it borne out by the facts? And here's another way of looking at it. Going back to 1980, there have been 32 years where it's been up, 1 year where it was flat, and 10 years of down years. So 32 of 42, last time I checked, is 74%. One flat year and down 11 and down 10 on 42 years. It absolutely bears out. But the thing that's really interesting on all of this, in every year in those 32 years, every single one of the years during that 42-year period of time, the market was down at some point, varying from down 3 to down 49%, peak to trough. So the point is, the fact that the market is down is not only not abnormal, it's normal. And the average down tick during those years about 14%. So here's the value of long-term investing. And, as you can see, they all look really good. But here's the Callan chart for asset class returns from different kinds of, U.S. stocks and developed market equity, et cetera. But the asset allocation portfolios, this gray area connected here, this is the way that we manage our clients' portfolios. What you will say is, it's not going to be REITs 1 year top and next year it's down, and then it's here and then it's up and it's up and it's up and it's down. The fact is, it's never going to be at the top, nor is it going to be on the bottom. And that's the point. Now, history of market corrections. Here's something else to keep in mind. When the market corrects, which is more than 10%, what's the type of decline? So what's interesting here is 5% or more happens about 3 times a year. The average length is 39 days. And the last occurrence was September of this year. This is going all the way back to 1942. This is for the S&P. This is for the Dow. And you'll see it's about the same. 3 times a year is 41 days, et cetera. 10% or more every 16 months, every 17 months, 15% of every 3 years, 230 days. And of course, all of this occurred during September of this year. And then 20% or more about every 5 years for the S&P, about 5 3/4 years for the Dow. Big market corrections, particularly bear market corrections, are very rare. They happen about every 5 years, and they last about little less than a year. So, again, let the facts inform your decisions, not the emotion that we all feel. Here's another way of looking at it. There have been 11 bull markets, and going all the way back to 1942, the average cumulative return of the bull market periods was up 155%, and they lasted 4.4 years. The average bear market was down 31% and lasted less than a year, 11 months. So as you can see, it's probably a pretty good idea not to get out during bear markets, because you're really not going to lose much, and you run the risk of missing these big bull market recoveries that come out of it. So the other thing to notice is the amplitude of the upside versus the amplitude of the downside. So these are really important things to keep in mind. And there you go. Here's one of the things that we were talking about this year is like, oh my gosh, we've had increasing volatility. This is volatility, the number of days of the S&P where it's got more than 1% moves. The average is 62 a year. This year, of course, has been more like 93. But in general, it's anomalistic. So there we go. So this is Jim Harvey, president of Opus 111 Group, and this has been your Money Week. If you find this interesting, I encourage you to go to our website at opus111group.com, particularly the Learn page, where you'll find other recordings like these, copies of my partner Mike's radio show, written and audio blogs to help you make better investment decisions and hopefully sleep better at night. Have a good day.